Welcome, everybody. Merrill Chandler here, your host of the Get Fundable podcast and this Get Fundable universe. So in this episode, I'm so excited. It just dawned on me after 130 podcasts or whatever. I have never gone through the structure of what mortgages, what is required to qualify for a mortgage. What types of mortgages are out there? Who sponsors the mortgage? Credit scores, minimums, debt to income ratios, the whole 9 yards. So when we come back, we are going to knock it out of the park, and we're going to give you not just the bird's eye view, but a boots on the ground review of what is required to qualify for mortgage and how your fundability can make it happen.
In the constantly changing world of fundability, the big question is this: how are entrepreneurs and real estate investors like us, ones who want to grow our businesses and who are tired of paying for really expensive alternative lending, how do we tap into the most inexpensive money available and do it without the hassle of typical borrowing? That is the question, and this podcast will give you the answers. Welcome to the Get Fundable podcast with your host, Merrill Chandler.
All right, everybody. Welcome to this episode of Get Fundable podcast. So take a look at the things that have been going on over the last few months, right? We've had this huge, if you recall last summer, there was this rush that certain regulatory agencies were adding like an extra fee because the mortgage rates were so low. They were adding a fee, an extra fee, just because the rates were so low. So they wanted to kind of pay back some of the losses that Fannie and Freddie had of Fannie Mae and Freddie Mac, the government kind of backed mortgage systems. They were paying back their coffers since they had really needed a bailout since the 2008 mortgage crisis, right? So this fee was being charged. And then since then, that was kind of repealed because there was there was an outrageous kind of an uprising among mortgage buyers saying, why should we be penalized with a tax that we didn't vote for or didn't come through the legislature? So huge brouhaha on that end. Then over the last 2 to 3 months, the mortgage rates are plummeting, and there's huge opportunities for refinance rates as low as, under 2%, right? So recently it's kind of crawled up a little bit, but these are outrageously low rates. So I wanted to weigh in and kind of give the 1,000-foot view and some specific ideas, specific tragedies, specific. If we don't implement these that I'm going to tell you, they will be tragedies. We want to implement specific strategies that are going to allow you to refinance or obtain your first or a new mortgage, right? So let's go over kind of what the requirements are for a mortgage. Not number one, there are 5 to 6, depending on how you break these down. There's 5 to 6 areas that are counted in whether or not someone will approve you for a mortgage. Number one is going to be, or it's not number one. These are not in the order of importance. There's credit score. Then there's your down payment, and then your income and employment history, so the amount of money you make and how long you've been making it. There's savings, like liquid cash that's available, not necessarily money that's in the stock markets or in real estate developments or equity, but liquid cash, savings, etc. Then how much is your debt load? Meaning how much of your debt to income ratio is how much of your gross monthly dollars are being spent to service your debt, right? Pay for your debt, including the interest. And separately, how much total debt you have in loans and unsecured, like credit cards and things. And then the last factor, which is why it makes it 5 or 6, the last factor is the loan amount itself. Those are the areas, right? The 6 areas that we need to focus on. So let's take a look at scores first. Your scores when somebody calls it a conventional loan, that's a term that's thrown around a lot. Conventional just means that one of the government-backed agencies that's going to buy the loan from the lender that you go with, that's someone who pays to put the loan on the house that you're buying. Those loans are then bought back by Fannie Mae and Freddie Mac. Fannie Mae is for single family homes, and et cetera, up to, I believe, up to duplexes. And Freddie Mac covers multifamily properties. Now, these two agencies require a minimum of a 620 to be approved at all. Now, when I say that, I'm saying there's a range. The top tier credit score to get the best rates, what's known in the industry as A paper, meaning it's just top paper, is a 740 middle FICO score. 740 FICO score, and it's the middle score. So if you have a 750 and a 710 and a 740, that 740 is the middle score, and it's not an average score, it's a middle score. They're choosing whatever the middle score is. So it is a minimum of 620 to even get a Fannie or Freddie backed loan. If you're getting an FHA loan, and by the way, those conventional loans go up to hundreds of thousands of dollars, including millions of dollars, for what are called jumbo loans. You want to check with your local mortgage broker to find out the cutoff, because just like I'm going to share right now, FHA loans may vary by your geography and the value of the homes in your area. So you've got to check out conventional loans. And when does a conventional loan hit the level with it's called a jumbo loan? That varies by of geography. So let's take a look at the Federal Housing Administration, which is another government-backed, but it has different. It's another government-backed loan, and it's offered by most mortgage brokers out there. But an FHA loan can vary anywhere between $356,000 all the way up to $822,000 by geography. But those are the ranges. Doesn't really go lower, and it doesn't go higher to qualify for an FHA. You can have as low as a 580 FHA. Now, just so you know, just as with the conventional or the Fannie Freddie loans, 580 is the minimum, and it requires a 3.5% down payment if you're in that, if you're above that 580. Sometimes you can get approved based on these other factors that we're discussing. Sometimes you can get approved for a mortgage for less than 580, but you have to put a minimum of 10% down on that property. Okay, stop right here. I know you're in the flow of the podcast. Whether you're watching or listening, I'm in the middle of post-production here, reviewing what I said, and it sounds very confusing. So let me kind of draw some straight lines here so we know exactly what we're talking about. I was talking about the FHA loans, the versus Fannie Mae loans. So let's define our terms. Government agency loans, actual portion of functions of the government, are to provide certain mortgages. That's FHA, right? That is those government agency loans are different and have different underwriting criteria. The rest of everything I'm telling you is spot on. Enjoy. But when I said government sponsored or government backed, the formal term is Fannie Mae and Freddie Mac are government sponsored versus government backed. I just wanted to make sure that we're clear on the terms, which means they're separate corporations, but they are backed by the government. So when Fannie Mae and Freddie Mac buy loans from your mortgage broker, from the banks, when they buy those loans and they fail, the government backs those loans through Fannie Mae and Freddie Mac. So they're not, Fannie and Freddie are not government agencies like the Federal Housing Administration, FHA, and the VA loans, et cetera, right? Fannie Mae and Freddie Mac are government sponsored. I mean, that backing is financial if the loans fail. So I just want to kind of bracket here for a second to make sure we know what we're talking about. Continue and enjoy. So those scores are the baseline, which means that you have to have all the other factors we talked about: down payment, income, longevity at work, savings, debt load, et cetera, all have to be much better. And we'll cover that in just a second. So there's the USDA rural housing loans require a 640 minimum. Of course, the higher the score, the better. And jumbo loans have to be a minimum of 680. So whatever definition in your geography, in your state or locale, whatever that the jumbo loan amount has to be a minimum of 680. Of course, we want it to be far more than the minimums. Now, think of score, down payment, income, employment longevity, savings, debt load, and the loan amount. Think of those as silos, right? And you've got 6 silos. Let's say they're worth 10 points each. So in order to have a perfect, absolutely perfect loan package to deliver to your mortgage broker, you need 10 points from each one of those for a total of 60 points. Now, these are made up numbers, but I'm trying to weave the process of approval, mortgage approvals with you. So that's a total of 60 points. But let's say you only need 40 points to be approved, right? So the higher the higher quality and fundability of your credit profile, the higher your score, then requires less down, or you can have higher debt load, or your existing debts can be higher, and your loan amount can be higher. So it's just making sure that we hit that 40 number, and given certain minimums, the FHA, Fannie, Freddie, et cetera, they don't care where the points come from in this underwriting process. With me? So the underwriting process just requires you to hit 40. Now, again, made up numbers, but there's a total of 60 available. So we have whatever we can do to improve our credit and make sure that we have the best fundable profile possible. We can have lower everything else, or worse conditions of everything else. Less time at employment, less income, less savings, more debt. Each one of those things come into play. Everybody with me? Now, let's talk about debt and income, because I said debt load matters. Well, there's what the familiar term is DTI, or debt to income ratio. That means what percentage of my gross income before taxes, what percentage of my gross income gets used in paying for my debts, right? And so debt to income ratios include how much am I paying for, so it's debt service, it's housing cost against my debt or against my income. All right. Now, in the last few years, there's normally conventional loans, the Fannie Freddies come in at 43% debt to income ratio is allowable. Anything above that, they say no. FHA and USDA loans are also 43%, and VA loans are 41%. Now, I coach my tribe to stay anything near 35%. You're in the sweet spot and you're fundable like a mad person. All right. But over the last few years, there's been a situation has arisen where some calculations of DTI are off. They're not dependable calculations. And so there's been a thing called a GSE patch, which allows the debt to income ratio to be lowered in the calculations. Here's what's crazy. There's been, according to the reports, there's been over 3.3 million additional people become homeowners because of this patch, right? Think of a software patch where you're just making something work because the system is kind of broken. And so debt to income ratio has not been as important of a consideration. In fact, in a recent study, it was found that Urban Institute says that debt to income ratios have not been typically calculated fairly, and they're asking Congress to remove the debt to income ratios as part of the calculations for approval of a Fannie, Freddie, FHA, or VA loan mortgage. That would allow millions more people to have a home ownership because, and to quote them, FICO scores are often better predictors of a borrower's ability to pay than the DTI is. And that's why there's kind of a brouhaha brewing of wanting to get rid of the DTI from the mortgage approval mix at all. Now, I happen to agree from my experience, both working with clients and students in helping them qualify for mortgages, that the income, because everybody wants to keep their home, right? Usually their mortgage payment is the last bastion that if there's unemployment or COVID kind of wiped them out, they want to do whatever it takes to keep making their mortgage payments. So it is the last bastion of protecting their financial future, right? So I applaud getting rid of the DTI as one of the factors for approvals, because it's not honestly, debt to income ratio, you can carry higher debt, but higher debt is including what you're paying for your mortgage. So and FICO scores are way better predictors. From my vast experience, FICO scores are way better predictors of the ability to determine someone paying honorably, paying their debt off, and keeping out of default. All right. So the last thing that I wanted to cover here is, now that we kind of have the rules of the game, right? What does a lender measure? A credit score, down payment, income and employment history. So how much money do you make and how long have you been making it? How much liquid savings, existing debt load, and the loan amount. Once we have those areas and the minimum scores, then we need strategies to help us build our profiles and establish a higher, not just a higher credit score, but the ability to tick off some of these make improvements in our overall ability to receive a mortgage, right? So many of us, I started this whole thing out, and many of us are looking to refinance. So the best way, here's some things, not in order, but here's some strategies for you to ensure success in getting a refi or getting a new mortgage. Number one, if you're refinancing, then make sure that your highest priority is to pay your current mortgage on time. Now, remember, in my boot camp, I talk about the 24-month look back period in 3, 6, 12, and 24-month increments. So the longer you're paying on the due date, your mortgage, the better you look to anybody who's going to be right or who wants to refinance you. Okay. So number one, pay your current mortgage perfectly on the due date. Second thing is, you want to maintain low of revolving account balances. That proves that you don't need money out there. Even if it's not true, you want to make, if you need money, I understand, but you want to make sure that the message you're sending with your borrower behaviors is that you can maintain low to zero balances for as long as possible. Again, over that 24-month look back period, 3, 6, 12, and 24 months makes you more and more and more valuable as a perfect mortgage borrower. And they're going to, the likelihood of you being approved is going to go up. So maintain lower balances. If you have to carry a balance, if you can do it, 10% is better than 20%. 20% is better than 30%. Follow me? 30% is better than 40%. So whatever you can do to get those down, do so. Now, if you have any charge-offs or unpaid charge-offs or collections, use the process called pay to delete to remove those collections or charge-offs. The less debt, bad debt that you have, things that you've gone late on or that's been charged off or collections, those count significantly against you. And so if you can pay those off, now the best strategy is not to just pay them off, but to contact the collector or contact the creditor and say, if it's worth it to you, listen to the language, if it's worth it to you to delete this, it's worth it to me to pay it. Will you delete this from my credit report, this negative notation, this derogatory account? Will you delete it from my credit report upon payment? And then negotiate the payment. If you get a yes from it, two things happen. You get a credit score boost because they delete any negative that account from your credit report. Number two, you don't have any old debt following you later on down the lane, right? Because it's been paid. And your fundability increases, not just your credit score, your fundability increases because you have made right with other creditors, and every creditor wants to see that you are the type of person that in your integrity are willing to make it right. That has high value when it comes to underwriting, right? Or when it comes to approving your mortgage. Now, if you do have to carry a balance on any of your revolving accounts, then always make above the minimum payment. Always make above the minimum payment. Never make a minimum payment, because what we're doing is the automatic underwriting systems are tracking what you owe, the day you pay, and the amount you pay. If the minimum payment required is all you're paying, that sends a message, I haven't got anything else. So whether it's true or not, we want to make sure that the system knows you're doing your best. And so always make $5 more, $2 more, $7 more. Never make the minimum payment. Always make more than the minimum payment. And the longer we do this, I keep going back to it, but all FICO 40 borrower behaviors rely on the 3 months of good behavior, 6 months of good behavior, 12 months of good behavior, 24 months of good borrower behaviors. We do that, the longer we can do it. So the longer we do it, the better off we are. Now, if you're looking to get refinance in 3 months, do these behaviors for 3 months. If you're casting forward a little bit further, you're looking to buy a new home out in the future, then now is the time to change your behaviors so that lender software looks at you and says, this is a great borrower and I want to lend them money. So if we have improved our borrower profile, our credit profile by using these simple strategies, then we may be able to have a higher credit score, a lower down payment. Our income doesn't have to be as much to get approved. We can have fewer savings and still get approved. We may have higher debt and still get approved. And we may qualify for a higher loan amount. You see how this works? Every piece can, if we do the right things to improve our profile, improve our borrower behaviors, then we can have the best chances of getting approved for a mortgage, and of course stay way above the credit score minimums required for approval. This is Merrill Chandler. Thank you for joining me on this edition of the Get Fundable podcast. And here's to you and qualifying for either a refi or a brand new mortgage.
Thank you for listening to the Get Fundable podcast. Please leave comments because Merrill would love to read about your aha moments from this episode. And be sure to visit getfundable.com to read our blog, get important links, join our community, and much, much more, like ordering Merrill's tell-all book that is changing the world, The New F Word. And you got to tell your friends about this podcast. because we want them to get fundable too.